You'll be surprised to find out how CBDCs and cryptocurrencies are more different than you think. Did you know that as of 2023, over 100 countries are exploring or have already launched central bank digital currencies, while the cryptocurrency market is worth trillions? It's wild to think about how these two digital currencies are rapidly changing the financial landscape. All right, let's dive into this. Today, we're talking about two hot topics in finance: central bank digital currencies, or CBDCs, and cryptocurrencies. You might have heard a lot about Bitcoin, Ethereum, and other cryptocurrencies, but CBDCs are the new kids on the block, and they're causing quite a stir. So, what's the deal? Well, both CBDCs and cryptocurrencies are digital forms of currency, but they have different origins, purposes, and implications for our financial systems. In this video, we're going to break it all down so you can understand what's what in this complex world of digital money. Welcome back to Financial Fitness, the channel where we help young adults improve their personal finances one rep at a time. Now, here's the thing with the rise of CBDCs and cryptocurrencies: confusion is running rampant. A lot of people see these two types of digital currencies and think they're pretty much the same. I mean, they are both digital, right? But there are some crucial differences that you need to know about. Understanding these distinctions is super important, especially as these currencies become more integrated into our daily lives. If you're investing in crypto or just trying to keep up with financial news, you need to know how CBDCs and cryptocurrencies differ, especially when it comes to regulation, control, and their impact on the economy. So stick around as we unravel this mystery. Let's break it down further. First up, central bank digital currencies. CBDCs are digital forms of a country's fiat currency, which is issued and regulated by a country's central bank. Think of them as a digital version of the cash you carry in your wallet, but with a tech twist. They're designed to work within the existing financial system, providing a safe and stable digital currency option. The goal of CBDCs is to enhance the efficiency of the payment system, reduce transaction costs, and promote financial inclusion. For example, countries like China with their digital yuan are already in advanced stages of implementing CBDCs. But let's pause for a second. Why should you care about CBDCs? Well, as young adults, we're entering a world where cashless payments are becoming the norm. Apps like Venmo, Cash App, and Apple Pay have already changed how we handle money. CBDCs could take this a step further by allowing us to make payments directly from a central bank account, potentially eliminating the need for commercial banks altogether. Imagine paying your friend back for lunch or splitting rent without worrying about bank fees or processing times. Plus, with CBDCs, there could be more security and less risk of fraud since the transactions are backed by a central authority. On the flip side, we have cryptocurrencies. These are decentralized digital currencies that operate on blockchain technology. Unlike CBDCs, cryptocurrencies are not controlled by any government or central authority. This means they can be more volatile and are often seen as a speculative investment. Cryptocurrencies like Bitcoin and Ethereum were created to provide an alternative to traditional finance, allowing for peer-to-peer transactions without the need for intermediaries like banks. The underlying technology, blockchain, ensures transparency and security, but it also raises questions about scalability and energy consumption. For many young investors, cryptocurrencies represent the future of finance. They offer a way to diversify portfolios and potentially earn high returns, though with higher risks. Platforms like Coinbase, Binance, and Robinhood make it easy to buy and sell crypto, but it's crucial to understand the risks. Prices can fluctuate wildly. Remember when Bitcoin soared to nearly $65,000 in 2021 and then plummeted. That's the kind of volatility we're talking about. But with high risk comes the potential for high reward, which is why so many young people are drawn to crypto despite the risks. So how do they operate? CBDCs are typically built on centralized systems, meaning the central bank has full control over the currency supply and transaction processes. In contrast, cryptocurrencies are operated on decentralized networks where transactions are validated by a network of nodes, making it harder for any single entity to control the currency. This fundamental difference is a big reason why CBDCs are viewed as a tool for government control, while cryptocurrencies are seen as a way to promote freedom and autonomy in finance. But here's where it gets interesting: CBDCs might actually help bring more stability to the crypto world. Some experts believe that once CBDCs are fully implemented, they could reduce the volatility of cryptocurrencies by providing a stable digital currency for people to trade against. Think about it, if you could easily swap your crypto for a digital dollar, it might make the whole process smoother and less risky. Of course, this is all still speculative, but it's a fascinating possibility. Here's the kicker: while CBDCs and cryptocurrencies might seem similar at first glance, they represent two very different philosophies about money and control. CBDCs are about centralization. Governments want to keep the reins on monetary policy, security, and regulation. In contrast, cryptocurrencies are all about decentralization, empowering individuals and promoting financial freedom. This key insight is crucial because it shapes how each of these currencies will impact the future of finance. Will governments embrace CBDCs to maintain control, or will cryptocurrencies disrupt the system and pave the way for a new financial order? The answer to that question could change the way we think about money forever. This battle between centralization and decentralization isn't just theoretical, it could directly impact our financial futures. If CBDCs become the norm, we might enjoy more efficient transactions and better protection against fraud, but we could also see increased government surveillance and control over our spending. On the other hand, if cryptocurrencies gain wider acceptance, we could experience greater financial freedom and opportunities for innovation, but we'll need to navigate the challenges of volatility, security, and regulation. It's important to consider how these changes might affect our personal finances. Whether you're a freelancer who wants to get paid in Bitcoin, or you're concerned about privacy and government oversight, the choices we make today will shape our financial landscape for years to come. So, to sum it all up, CBDCs are digital versions of government-issued money, designed to work within the established financial system, while cryptocurrencies are decentralized digital assets aimed at promoting freedom and reducing reliance on traditional banking. Understanding these differences is essential as they both continue to evolve and shape our financial landscape. Whether you're a crypto enthusiast or just curious about CBDCs, knowing what separates these two can help you navigate the rapidly changing world of digital currencies. In the end, there's no one-size-fits-all answer to whether CBDCs or cryptocurrencies are better. It all depends on your financial goals and your perspective on government control versus financial freedom. But one thing's for sure: as digital currencies become more mainstream, they're going to play a huge role in our lives. And staying informed is key to making smart financial decisions. What do you think? Are you team CBDC or team cryptocurrency? Drop your thoughts in the comments below. I'd love to hear your opinions. And if you want to dive deeper into the world of digital finance, check out our other videos on this channel. Don't forget to like, subscribe, and hit that notification bell for more awesome content. See you in the next video.